Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi Singh. I'm the Chief Investment Strategist at Standard Chartered Bank India. We have just released our monthly India Market Outlook titled Balancing the Risks. In today's podcast, we summarize our macro and key asset class views. The fourth quarter had a mixed start as rising commodity prices amid escalating geopolitical tensions in the Middle East and a persistent rise in bond yields drove a correlated fall across domestic equities and bonds. Indian risk assets trailed global peers after many months of relative outperformance. We see geopolitical tensions in West Asia as a key source of risk to India's strong macro fundamentals given a large dependency on energy imports. Nevertheless, strong second quarter fiscal year 2024 earnings delivery and a likely peak in bond yields are supportive of Indian assets. We believe a calm strategy that takes a balanced approach to foundation portfolios and opportunistic allocation remains a prudent approach to tide through the near-term uncertainty. We propose 4 ways to do this: C for capitalize on market opportunities, A for allocate broadly, L for lean to Asia, and M for manage volatility. Coming to our macro views, on growth, we expect India's economic growth to track above its long-term trend and stay ahead of its major peers in second half of 2023, with India's growth likely to be resilient to weakening global growth given supportive government policies, sustained revival in services, and a pickup in private capex. As per Bloomberg estimates, India's fiscal year 2024 GDP growth is expected to be around 6.2%, which remains higher than peers. In our assessment, fiscal policy is likely to be the key driver of growth in 2023 as financial conditions continue to remain tighter than normal. The past measures undertaken by the government, which includes greater public capex spend, long-standing reforms related to taxation and labour, and providing incentives to boost manufacturing and infrastructure, is likely to boost India's medium-term growth outlook. On inflation, we believe CPI inflation is likely to trend lower in 2023, tracking within the RBI's medium-term target range of 2% and 6% given high base effect, lagged impact of monetary policy rate hikes, and a gradual easing of commodity prices. Coming to key asset class views, we remain neutral on Indian equities as robust domestic growth and strong corporate earnings cycle is counterbalanced by stretched valuation premiums both absolute and relative to peers. The Nifty index registered an earnings growth of 11% in fiscal year 2023, while the expectations for fiscal year 2024 and 2025 are estimated at 14% and 17% respectively. Within equities, we upgrade large cap equities to overweight given greater margin of safety over mid cap and small cap equities in terms of earnings and valuation amid tighter monetary policy and liquidity conditions. On sectors, we prefer a barbell strategy where we prefer domestic cyclicals and accordingly maintain an overweight on financials and industrials. We balance this by a defensive tilt in the portfolio through an overweight on healthcare. On bonds, we continue to maintain our neutral stance as we expect attractive absolute and real yields to be counterbalanced by below average yield premiums, stretched medium-term fiscal position, and weak government bond demand-supply balance. In our view, the RBI's decision to keep policy rates unchanged in its past few policy meetings despite the recent surge in inflation trends likely signals an end to the tightening cycle. We expect the 10-year Indian government bond yield likely to trade in the range of 6.75 to 7%. We see the recent surge in bond yields as an opportunity to lock in attractive yields given the increased likelihood of a peak in bond yields amid receding inflationary pressures and pause in policy rates by the RBI and major global central banks. Within bonds, we are overweight medium and long maturity bonds. We have a preference for corporate bonds over government bonds, as in our assessment, corporate bonds offer a better risk reward amid attractive spreads and improving corporate fundamentals. In addition, higher absolute bond yields and lower currency volatility provide a stable carry relative to other emerging market peers. However, we remain mindful of 3 factors which remain unfavorable for bonds, and they include: first, fiscal deficit is likely to remain high over the medium term. Second, worsening government bond demand-supply balance given high supply of government bonds and a lack of support from the RBI. Third, higher than expected inflation could keep bond yields elevated as the RBI maintains a prolonged pause on policy rates. Cash continues to remain a neutral holding, and finally gold remains a core holding and a key portfolio hedge against elevated inflation and equity market volatility. That's it in this edition of the podcast. Do reach out to your relationship manager for a copy of our India Market Outlook, and thank you as always for listening. If you enjoyed this podcast, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.